What's up guys, today we're going to talk about fundamental analysis again. Now if you haven't watched my introduction to fundamental analysis video, you should go check it out. I'll put link down in the description below. Whether you're a fundamental trader or technical trader, short-term trader, long-term trader, you need to know what moves the market, and one of the major factors that's going to move the markets, especially in the short term, is what central banks do, because their actions can cause the markets to move without you even noticing it, especially if you don't monitor the fundamentals and rely only on technicals. So by the end of this whole entire video, you can understand some of the basics of central banks, how the actions can affect the market, potentially help you increase profits and minimize your risk. So the first thing first, what are central banks? Regardless of the country, it implements monetary policy for that particular nation or that particular group of nations, and in this case the European Central Bank, which we'll talk about more later on. Another function of the central bank is that it functions as the bank of the government. So one of the major functions of central banks that most people talk about, especially in the news, is that they determine the interest rates. Okay, but the central bank doesn't really make a major shift in interest rate, because normally these monetary policy changes only involve small changes in interest rate, normally ranging from 20 to 50 basis points. Because here's the thing, if the central bank shifts the interest rate too dramatically, it's going to cause a shock in the economy, and the central bank doesn't want that, especially on normal times. Only on a case-by-case basis, let's say in 2008 financial crisis, then central bank would make drastic changes. But in normal times, the central bank tries to keep everything as normal as possible, not too much changes, so that people won't get too surprised by this sudden change in interest rate. So some of the common terms used by the financial industry, especially when it comes to central banks. The first one is hawkish. And what does it mean by hawkish? It means that the central bank is planning to increase interest rate because they're concerned that the economy is growing too fast. So how does increasing interest rate help slow down the economy? So when interest rates are increased, it means that businesses, when they want to borrow money, the rates are a lot higher, so they're least likely to borrow money for the businesses. And at the same time, for people who are consumers, because of the increased interest rate, people will put more money in the bank rather than spending that money. People are spending less money, then there are less money circulating in the economy, and hence when there's less money circulating in the economy, then the economy will gradually slow down. And on the other hand, when the central banks are dovish, it means that they are planning to decrease interest rate or cut interest rate because they are concerned that the economy is slowing down too fast. Central bank cuts interest rates. Businesses can borrow at a better rate. Because they can borrow at a better rate, they have more money to spend. When they have more money to spend, there's more money circulating in the economy. There's less interest rate, people will be least likely to put money in the bank. Means they would have more cash on hand. And when people have more cash on hand, it's very tempting to spend money. As when they are tempted, they would do it. They are going to spend it. So when people spend money haphazardly, go shopping on the weekend, there's more money in the economy, then the economy will gradually grow. So then the question is, how do you determine whether the central bank is hawkish or dovish? One way you can do it is to look at US government debt, to be specific, treasuries. So when there's a decrease in yield, it will mean that the central banks are dovish. So when the central banks are dovish, this would be negative for the currency. And on the other hand, when yields are increasing, it means that the central banks are hawkish. And when the central banks are hawkish, it means that this will be a positive for the currency. So another common term that's used is intervention. It's an action by the central banks to induce movements in the rate of the currency. So the central bank doesn't intervene all the time. It only intervene on specific events, extreme circumstances, such as the 2008 recession. And when there's a major disaster, then the central banks will intervene. What do they intervene for? Intervene to stabilize the financial markets. So it means that they will only intervene when there's no more other choices. And when it comes to intervention, you already know that different countries have different central banks. Different central banks have different impact on the financial markets. Some central banks have more power, some central banks have less power as compared to this one. I'm going to talk more about that on the different central banks later on. So why is central banks so important, especially for you as a forex trader, is because they are the main drivers of the forex markets. And why is that so? It's because they are the one who controls the interest rates. Now, central bank can only control the short-term interest rates, whereas if you are talking about the long-term interest rates, it's determined by bond investors mainly. So the central banks, what they can do is that they can intervene the currency markets, and when they do intervene, it's gonna produce a major spike, temporary spike in the market. So after that, the market is gonna stabilize down and then continue its movements. So even though the central banks can produce major movements in the currency markets, different currency pairs, they would have different reactions, different sensitivity to the actions of central banks. Let's say, for example, if you are trading dollar yen, then dollar yen would be way more sensitive as compared to other currency pairs. So different central banks, they have different functions, they have different main focus. So for example, the Fed, their main focus is to ensure full employment. Of course, central banks also regulates the credit system. And as a bank, of course, they also issue currencies and they restrain inflation. And how do they do that? They manage the amount of money in circulation. So of course, for the ECB and then the Fed, their main focus is also to ensure price stability. Central banks also manage a country's foreign currency reserves. So of course, different countries have different central banks that you need to take note of. Number one, United States. So when people talk about the Fed long term, it means Federal Reserve. You need to take note of the Bank of England, Bank of Japan, BOJ, ECB, European Central Bank, RBOA, Reserve Bank of Australia, PBOC, People's Bank of China. Why do we need to focus on China? It's because a lot of countries rely on China for its exports and imports, which is why China's economy is going to affect the economy of other countries indirectly. And then of course you have the Swiss National Bank. So let me just go through one by one. What's the main function of all these individual central banks? So the first one, the most talked about, US Federal Reserve or the Fed, is the United States Central Bank. It's monitored closely by traders who trade US dollar. Now US dollar is actually a reserve currency. So what does it mean by reserve currency? In other words, it's a safe haven currency. So some of the safe haven currency aside from US, you have the Japanese yen and then you have the Swiss franc. So what does this mean for you? It means that during a recession, what you can do is that you'll know that the safe haven currency would go up because why? All the money would flow into safe haven currencies during tough times, during recession times. Even though the stock market, equity market will be plunging, index will be plunging during recession, but then you can take advantage of the increase in all these three currency pairs. So of course the main function of the Fed, aside from ensuring maximum employment, is to maintain the financial stability of the US markets. Then of course you have also the Bank of England, which manages the currency pound sterling. And they're responsible for managing UK's interest rates, and their main function is to ensure monetary stability by maintaining the inflation rate. Whereas for Japan, you have BOJ. Their main responsibility is to determine the interest rates for Japan. Now of course, Japan being an export-driven country, when you're an export-driven country, you don't want your currency to be too strong. Otherwise, it will become too expensive to do business with Japan. So what the Bank of Japan do is that they'll intervene to prevent yen from becoming too expensive. And how do they do it? They do it by selling the currency. Of course, all these currency matters are handled by one of the biggest ministries in Japan, which is Ministry of Finance, or MOF. And in fact, a lot of times the Ministry of Finance would have a larger economic impact than the Bank of Japan. So aside from Bank of Japan, you also need to take note of the actions by the Ministry of Finance. Whereas for European Central Bank, in short ECB, main function is to manage inflation, help the country achieve currency stability. So it means that things like growth and employment, of course, still would be their concern, but then it wouldn't be their main focus. It would be their secondary focus. Of course, Europe also being an export-driven country, same thing, you don't want your currency to be too expensive, otherwise it will be too costly to do business with your country. Of course, for ECB, the Governing Council is the primary decision-making body. And lastly, you have the Swiss National Bank, in short SNB. is the Central Bank of Switzerland. Of course, its decision is going to impact the movement of Swiss franc. And since most of the trade of Switzerland is conducted with Eurozone, SNB not only focus on Swiss franc, but they also focus on Euro a lot. SNB's main focus is to maintain economic growth and price stability. And they use the 3-month LIBOR market to steer interest rate. Now what's the LIBOR market about? It is the London Interbank Offered Rate. Okay, one more time. London Interbank Offered Rate. Professor taught me this a lot of times about LIBOR markets, but I'm not going to go into detail. But to put in summary, what is it all about? It's used by banks to determine what interest rates that they should charge. It's used by banks to calculate their interest rates. Meaning that LIBOR market is used as a benchmark.